Hello, everyone. Thank you for joining us today. I'm Marcia, the webinar director here at Advice Chaser, and we're excited to have you here today. As people are coming in the webinar room, and before I introduce our guest, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your contact information as well. If we can't get to your question during the event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Kelly H. Clyde is a co-founding partner with South Coast Investment Advisors and a registered principal and a lead advisor with the Independent Financial Group. Kelly is a wealth manager that works primarily with rental real estate owners who want a clear look into their overall financial picture, guidance on how to best manage their liquid assets to complement their real estate holdings, and advice on how to ensure their portfolio is generating efficiencies to reduce annual tax burdens. Kelly focuses on clear and candid communication while utilizing the South Coast process to achieve each individual's goals for themselves and generations of their families to come. His clients look to him as their personal CFO, helping grow their wealth and protect their legacy through highly personalized portfolio management. He uses a broad spectrum of traditional and alternative asset classes and investment strategies to adapt portfolio allocations to the ever-changing economic landscape. Kelly holds FINRA Series 7, 24, 31, and 66 securities licenses, as well as his California life and health insurance license. He graduated from the University of California, Santa Barbara with a BA in business economics and an emphasis in accounting. Kelly, I'm really excited to have you here to present, and I hope our attendees know they're in for a treat. We had quite a long conversation preparing for this, and so I'm going to go ahead and turn over the time to you.
Thank you very much, Marcia. I appreciate, I didn't realize how long that introduction is going to be. So I'm going to, for the sake of keeping on course, I actually have some notes to keep me on task today. I've been in this business since 2004, about a week after I graduated from UC Santa Barbara. And it's been a very, very interesting, almost 2 decades. And so I've got a lot to share, but I'm going to do my best not to overwhelm. I will say, if I use any terminology that you don't understand, please go ahead and ask in the chat box so that I can address it. The last thing that I want to do is go through all these explanations and have none of it stick because I lost you, at the third sentence in a particular word there. So please go ahead and ask. It's a very interesting time to be an investor today. Obviously, if you're paying any attention to the markets at all, it's been a rough road so far this year. I would say it's one of the hardest times in history to be an investor because we have access to so much information, but really without a filter, it's impossible to figure out what's what, where are we going, where have we come from, and that's at the fundamental core of how to be a successful investor. So the goal today is just to take a little bit of your time to walk you through some of the things that you should be thinking about, some of the core terms to understand to better prepare yourself and essentially walk away with a filter so you can make good investment decisions for yourself. So we're gonna kind of start at the top here as far as what is a security, because not everybody wants to be actively invested in a business. You know, I run a business, but I am not out there trying to run Apple or Microsoft. So the idea is, how do I invest in organizations like that without having to be up in Palo Alto or wherever they've moved their corporate headquarters, or working from home like so many people? So the idea is, what is the security? It's essentially a vehicle that allows folks to invest passively in a variety of different types of businesses. So the first and simplest example of a security is a stock. That allows you to own essentially a share of a business. Interestingly, there are traded stocks and there are companies that are privately held stocks. And those you won't see traded on an exchange like the New York Stock Exchange or the NASDAQ and so on and so forth. So shifting gears from stock and actually owning a piece of the business, you can be a bond investor, and you're actually lending money to that business over a stated period of time, earning a stated rate of interest. We're going to get into kind of what drives both of those in terms of value, higher or lower, and some of the key factors to look at. The last two items there, ETFs, that stands for exchange traded fund, as well as mutual funds. They're very similar, but they are not the same. There are some important differentiators that we don't have time to get into today, but essentially they both allow you to invest in a broad basket of businesses. They may be from the same country, they may be from the same sector, they may be from a similar line of business, or it may simply be a portfolio strategist that thinks that they're the best stock picker in the world, and they're building a basket of the best and brightest picks that they have on a given time. So there's lots of different ways to be invested, and frankly, these four are only a few, but it's really good to kind of start there and understand, if I were to take that step to invest, how do I do it?
Hey, before we move on, we did have a question here. You talked about bonds being lending money to a business. What about lending money to the government? Can you talk about U.S. bonds?
Certainly. So again, one of the lowest risks investments that you can make, it's actually considered, even though it may not necessarily be, a riskless investment, is lending money to the U.S. government. The idea being that a lot of stuff can go haywire, but the reality is they're still going to figure out a way to pay. Whether it's printing more money to do it remains to be seen. But ultimately, you can not only lend money to businesses, but you can lend money to municipalities that are located in your state. So you can invest in municipal bonds, or you can invest in treasury notes, inflation protected securities that are offered by the Treasury, and treasury bonds. And really the only delineation between a treasury note and a treasury bond is the duration that you're actually lending the money to that government. Longer dated loans are going to be a bond, shorter dated loans are going to be a note.
Thanks so much. We'll go ahead and move on to the next part.
So I think this is the most important thing to take away from today's presentation, because if you're not in the trenches like I am, it can be very, very hard to get lost in, why is this all happening? What is really driving the stock market higher or the stock market lower? And in my opinion, there's two very, very fundamental drivers that dictate what if a value of a business is going up or going down or going nowhere. And those two things are earnings, and that is the profitability of that business. And so when Apple is selling their iPhones and they cover all their manufacturing and distribution and marketing costs and all the other elements, what their profit is at the end of the day is what's driving the value of that business at its core. Moreover, the future earnings, as we're going to talk about shortly, are more important, or the outlook for future earnings are more important than, basically the earnings over the last 6 months, the last 12 months, or the last 5 years. Because we're buying a stake in that business now, going forward, and not necessarily investing in that business in the rearview mirror. So earnings, incredibly important driver for what a business is worth, but almost equally important, kind of 1A and 1B, are emotions. I think if you've paid it all, any attention to, you turn on a business channel or what have you, there's always some talking head that's yelling, buy, 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 sell, 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 sell. And really, they're trying to cultivate emotion. And so what's really, really important to understand is that if the will of the market collectively is that the road ahead is going to be more positive than it's been, you're likely to see the market go up. And it could be in a scenario where earnings may not necessarily be growing, or earnings may be going down or have recently gone down. So the role of emotion in the market is incredibly important. And for those of you that were around back when the tech bubble burst in the early 2000s, the Fed chairman back then was a gentleman named Alan Greenspan. And during some of the testimony he provided to Congress, he talked about the concept of irrational exuberance. So what in the world is that? Essentially, it was so many people thinking the internet was going to be this complete and utter game changer that I can invest in dogfood.com that has no headquarters, that is not selling anything, but basically I'm just buying stock in this business because they've got a web domain, that it's going to be worth more in the future. And ultimately, it was that emotion that led to a lot of people having very, very poor outcomes. And so we're going to key back in on the role of those two factors as we continue to go through this. So one of the key terms for folks to understand helps us figure out value, fair value, overvalue, undervalue. Everybody likes to buy something at a discount. Nobody likes to be the sucker that overpays. And so one of the key metrics to help folks understand whether they're the sucker or they're getting the deal is this concept called the price to earnings ratio, also called the price to earnings multiple. And it's very, very simple. All we do is we simply take the price that that stock is trading for, and we divide by the amount of earnings per share that that business is generating. So very simply put, if a stock is selling for $10 per share and it's generating $1 per share of earnings, that business is said to be trading at a price to earnings multiple or a price to earnings ratio of 10. Again, that's basically saying that I'm willing to pay $10 today to buy $1 of earnings that that company has just created. So as I mentioned previously, I guess what's the old saying, what have you done for me lately? In the world of investing, it's actually, what are you doing for me tomorrow? What are you doing for me 6 months from now? What are you doing for me in the next 5 to 10 years? Frankly, when it comes to the stock market, there is much, much less emphasis on the performance of a business in terms of their profitability looking backward versus what the guidance or expectation is for that business on a go-forward basis. And so it's very, very important to understand the difference between the traditional price to earnings ratio, which tends to be backward looking, price divided by earnings that company has recently generated, versus the forward price to earnings multiple or price to earnings ratio. And that's taking the price today and dividing it by the expected earnings over the next 12 months. So again, if the expectation is for $2 worth of earnings from that company that was valued at $10 and they generated $1 of earnings last year, well, it doesn't take a mathematician to realize that's a huge amount of growth in that business. So that would potentially drive the value of that stock higher because that earnings is growing, all other things being equal. So that's why the road ahead and keeping your eyes forward, very, very important when it comes to investing. Also very important when it comes to controlling those negative emotions that can lead to bad decision-making.
Oh, that's very interesting that you bring that up, because I'm thinking about a lot of these companies that don't make money in the first, part of their existence, but they're valued much higher. And are you saying that the reason they're valued that high is because their future is so bright, according to what the emotion is and the expectation is at the time?
It's a great question. And the perfect example of that is Amazon. I can tell you right now that there are Amazon packages sitting on my front doorstep because my wife shops there all the time. Amazon's a business that's been around for a very, very long time. They launched as a platform to basically sell books online. They killed Borders, and then they subsequently went on to play obviously a massive role in how commerce, not only just e-commerce, but commerce is conducted today. Amazon, for a very, very long time, was losing money. So not generating profits. But if you look at the chart of Amazon stock, it was going higher and higher and higher, in part because their revenues were growing. And the expectation was in the future, those revenue, the revenue growth was going to start to exceed their expense outflow. They would be generating profits, and those profits would be massive. I can remember buying Amazon stock myself some time ago and thought I was an idiot to be buying it at the price I paid. And as it turns out, they've continued growing, they've become profitable, and it's been a great investment.
That's really interesting. Thanks for that example. Let's go ahead and look at this chart here that you sent over to me.
So there's a lot to digest on this slide. I will be the first to admit that. I think the key takeaway from this is not how the chart, over time has gone up. I mean, essentially what you're looking at is a price chart for the S&P 500. The S&P is what you hear a lot of people refer to as the market. That is 500 very large companies that are located here in the US. It is a basket of companies where the bigger you are as a business, the more you push and pull on the value of that index. That's more of an investing 2.0 concept, but something to understand that not all 500 companies are represented equally in that benchmark. But going back into what you're looking at here, which probably looks like a bunch of junk, quite honestly, the key thing that I want to drive your attention to, and we'll start looking back at March 24th of 2000. The forward price to earnings at that time was 25.2. What in the world does that mean? It means that at that time, market sentiment was really positive. People thought that the tech run was going to keep going, and they were willing to pay an arm and a leg, historically speaking, to go ahead and buy that business today because growth was going to continue to happen, and therefore the price that I paid would be warranted. It may be a year or two down the road, but it would be warranted. And so you see that obviously that didn't play out. And where people were paying 25.2 times the expected earnings of the S&P 500 at that point, things shifted. For a variety of reasons, things shifted and emotion took hold. Now, earnings weren't there, obviously, during the tech bubble. So that was a key element. But also, selling begat more selling, that begat more selling, and a lot of people were freaked out, as they should have been, when the market lost 49% so quickly. And so as we pivot to where the market bottomed out in October of 2002, if you were to have wisely taken $1 and invested at the bottom, your dollar invested in the S&P would be buying buying $14 worth of earnings at that time. So said the other way, your $14 is buying $1 of earnings. Previously, someone was willing to pay $25 for that same dollar of earnings. So you can imagine for those businesses that were still in business, people were still very, very scared about their ability to come out of what was known as the tech wreck at that time. And so if we look at some of these other inflection points, like March of 2009, the market in the beginning part of 2009, the S&P fell an additional 20% after getting walloped toward the end of 2008, after Lehman Brothers went out of business and Bear Stearns went out of business. Well, ultimately, that proved to be a bottom. And people said, you know what, this can't go down much more. in large institutional investors who stripped emotion out of the equation, said this stuff is on sale, and they started buying. And you can see they were paying $10.40 for $1 worth of earnings. So a lot of pessimism, and institutions by and large were able to be contrarian, set their emotion aside and buy. And as you can see from the way that things pan out thereafter, it was a great ride to be on. So again, when we're talking about this price to earnings multiple, it's just a measure of value. When we talk about forward price to earnings, we're not looking backward, but we're looking at the earnings of these businesses over the next 12 months. So the $1 million question for all investors is, am I overpaying? Am I getting fair value? Or am I getting a deal? And so as we toggle to the next slide, this one helps illustrate kind of the roller coaster ride of emotion that is the stock market. And I find myself referring to the stock market almost as a being, like a living being, because just like we as humans, it's being driven by humans in such an emotional setting. And so what I want you to take away from this chart is that over the last 25 years, the green dotted line running along the middle, that is the average valuation of the S&P 500. So when we take the next 12 months of earnings, take the price today and divide it by the next 12 months of earnings, the average has been a little bit under 17 times, meaning I was willing to pay $17 on average to buy that $1 worth of earnings. But as you can see from this chart, we blow hot and we blow cold more than we sit at the average. So it's really, really important when you're trying to decide, do I stay? Do I go? Do I add? Do I sit on the sideline? This is a really, really important indicator of, are things running too hot? Are we potentially experiencing another course of irrational exuberance like Fed Chair Greenspan talked about back during the aftermath of the tech bubble? And so it's important to look at the elements of valuation, and specifically that forward P is a great way to do it. So we're going to talk a little bit more about the role of earnings and emotion on the next slide. And what I want you to understand is, while they are sort of 1A and 1B, in my opinion, in terms of the role that they play, they're not always going to push and pull in line with one another or offsetting one another. Generally speaking, there are periods of time where earnings are driving the performance of the market much, much more so during than emotion. Generally, those periods of time are when there's not a lot of bad news, okay? There's not a lot of things to be scared of. And frankly, right now, there's a lot of things to be scared of. So it's understandable that emotion is playing a larger role today than earnings. And so when we look at the next slide, this is this year. Now, mind you, this is a slide from JP Morgan. They provide great research. This is looking at where were we at the beginning of the year and where were we at the middle of the year. And as you can see, the top gray line is earnings. And one would expect the market, having gone down as much as it has, that earnings would have also gone down. And as you can see, that's actually not the case. So from January 1 through June 30 of this year, earnings of those 500 large companies in the US were actually up by 6.7%. So that's kind of counterintuitive. Why is the stock market down if earnings are higher? Well, it's because we can't help ourselves but read stuff on online, Facebook, watch MSNBC, CNBC, Fox Business. I don't care where you're getting your news, but the news is all around us and it's scary. And so what you're seeing is the blue line is multiple growth, which in this instance is negative, which means that the price to earnings multiple that people are willing to pay is contracting and it's going down. And it's going down so significantly that it's offsetting the favorable input of earnings actually growing. And so we're in a situation where businesses have been able to continue growing little by little throughout the course of this year. And we really haven't felt, you heard the term recession. Well, recession is our economy essentially contracting. And in the US, we have a funny definition, and it's not really a definition. It's a group of economic advisors that say, hey, we were in a recession. It's always backward looking, not forward looking. There's a lot of talking heads out there that think we are headed into one. But that recession, we won't necessarily be in it until we start to see unemployment go up and earnings of businesses start to go down and the economy actually contract. And so what the expectation is, me reading the tea leaves of this chart, is that the market, Mr. Market or Miss Market, is thinking that the road ahead is not going to be near as nice as it was last year, the year before, and the year before that. And therefore, we need to take our chips off the table and we need to go run and hide to a certain degree. And that's why emotion has been a huge driver for market performance this year. And equally, once we find bottom, there will be a driver where, and we're going to talk about the Federal Reserve's role in things in the future. When the Fed potentially changes their stance, you're going to see that emotion turn and turn quickly in all likelihood. And we could see very positive reversal of course. So when it comes to looking at a very large index like the S&P 500 or the stock market in general, it's important to understand that it's not, I use the analogy, it's not 68 degrees and sunny all across the US today. There are certain places in the US where it's probably 68 and sunny, but it's definitely not that at my house today. And so one of the great ways of breaking down the stock market into component pieces are to look at businesses that are quantified or called value-oriented businesses or value stocks versus those that are called growth stocks. And so when we get into what is a value stock, what makes it a value stock, that's typically a company that's been around for a little while, that has very stable earnings growth. Generally, they're a company that may even have enough earnings that they are distributing some of their profits to their shareholders in the form of dividends. So you're actually getting some of that income from that business paid out to you. So value-oriented businesses tend to trade historically at a lower price to earnings multiple than that of the other type, which are growth-oriented businesses. Growth-oriented businesses might be, that great Amazon example where at one point they had no profits, they were losing money, but the future was perceived to be better than the current in the present, and therefore they were able to achieve that. And so when you have a business where the future is brighter than the present, and the market believes that that's the case, you have a business that may be losing money or maybe making money, but instead of paying out the profits in a form of dividends, they're reinvesting in their businesses to continue to spearhead growth. And so you'll see that these two types of investments, of stocks or categories of stocks, they don't always move in unison. One will be in favor and one of them might fall out of favor. And so if we go to the next slide, we can kind of see graphically how this is played out historically speaking. And so just kind of quickly to explain what's going on with the slide, if we are above that long-term average, and don't get tied up in what that long-term average even means, but if we are trading above that long-term average, it means that value stocks are expensive and growth stocks are cheap. Vice versa, when we're below that line, and you can see we're going back to 1997 all the way through 2021, you can see that growth stocks have had periods of time where they've been very, very expensive. And on a relative value basis, value stocks were perhaps a better buy at that time. And so I'd like to, before we toggle forward, just focus on the recent past. We had a period of time where growth, there was a lot of concern about growth coming out of the great financial crisis. And so a lot of investment capital flowed to value businesses, tried and true businesses that had stability in their business model. And so value-oriented businesses saw their stocks price edge up higher relative to the performance of growth businesses. And then subsequently, when COVID happened, and businesses like Zoom, like Peloton, you can work out at home, and all of these sort of businesses that were kind of on the fringes, perhaps, there was this huge opportunity for them to see growth, and investment capital flooded there. And so you can see that very quickly, the environment shifted from value expensive and growth cheap to the opposite, where growth was really, really expensive and value was cheap. And actually, so far this year, you can see right at that tail end of that slide where it bottomed out basically at the end of last year, we've seen a shift as all of those scary things that I don't have time to go into have hit the market. People have started to shift away from those growth names over into more value-oriented businesses. So there are periods of time where a given investment style is going to make a whole heck of a lot of sense. But I can tell you there is no silver bullet out there, meaning there is no investment thesis that is going to be the best way to be invested in every single market environment. And I love to use the analogy of there's a period of time to use a shotgun to get very vast, broad exposure to risk assets. When I say risk assets, I mean stocks, where we are an investor in the business. There's also periods of time where things might be a little bit more dislocated and not all moving in unison, where it makes sense to take a scalpel approach and be very, very particular about how you are investing. So perhaps instead of buying all 500 companies in the S&P, maybe you say, I want to buy just those value companies. Or perhaps I really like energy companies, utility companies, or I like this particular name. I can't help myself but keep buying Apple products. So perhaps that is a name right now that will outperform the broader market. And so when we look at the next slide, this kind of helps to illustrate that there are periods of time where most of the market is valued very similarly, and periods of time like now in the recent past, where the value of the different companies, and again, using the S&P 500 as an example, that they are dispersed all over the map. And so, again, this slide probably doesn't mean a whole heck of a lot to you, but the takeaway should be, look at a period like 2009. So that's right where the tail end of all the drawdown of the great financial crisis. And you can see that gray band. That gray band is showing the most expensive stocks, or really the stocks in the 80th percentile of valuation of the S&P, of those 500, down to the cheapest, or the bottom 20%. And it's a very narrow band during that period of time. That is a great environment when that band is small to just buy everything. Don't try and outsmart yourself. Don't try and figure out that Microsoft is better than Apple or anything like that. That's a great time to buy the index. Or you probably heard, if you've invested with Vanguard or anything like that, that you can just use those ETFs and those mutual funds to get broad-based exposure and just be in. Now you fast forward, sorry, go ahead.
Yeah, I just wanted to say you did use the word index, and maybe people don't know what that means.
Sure thing. So there are a number of different indexes out there, the S&P 500 being the most prominent index, and essentially is a basket of those 500 large US stocks. There is another index, the NASDAQ 100. That's 100 large stocks that trade on the NASDAQ. And then there's small cap indexes like the Russell 2000, mid cap indexes, which are medium-sized companies, small companies. And so an index is just a mechanism to break down the broad market into its components that are sort of like sized, if you will.
Thanks. And you wanted to talk about, I'm sure so we talked about the narrow band. Are you going to talk about the large band?
Absolutely. Thanks for bringing me back to center there. So if you look again now in the recent past, that gray bar has been much, much wider. And the takeaway has been that there are certain companies in this index that have seen their values absolutely soar versus some companies that may not have gone up at all, or may have gone sideways, or may have gone up just a little bit. And so when we look at kind of the top of that gray bar, we're looking at the highest price to earnings multiples. And we look at the bottom, we're looking at the lowest price to earnings multiples. And so when you enter a period of time where that dispersion between most expensive and least expensive is very broad, that may be a signal for you to think about investing with a scalpel again, instead of the shotgun, where instead of buying the entire market, where we're getting all of these really expensive names in with those that are perhaps better priced, instead look to perhaps use a vehicle like an ETF or a mutual fund that has a more specific approach, where they have a narrower band with what they are investing. There are great outfits out there that instead of having 1,000 companies in the portfolio in the mutual fund, they might have 20 companies or 50 companies. And so it's a much narrower focus. And so they might be able to find and uncover value a little bit better during periods of time where markets are dislocated in the fashion that they are right now. So the old saying goes, it's not timing the market, but it's time in the market that is the most important thing that we need to remember. I'm going to say that again because it's that important. We should never try to time the market. We need to remain focused on the time that we spend in the market. And the next slide will show exactly why it's incredibly important to push the negative emotions to the side. Again, assuming you have a time horizon that allows you to remain invested over the long term. And that's something, time horizon, we don't have time to really address today, but incredibly important. This is a slide that references these gray bars are the actual annual performance of the S&P 500 going back to 1980. As you can see, by and large, most of those gray bars live north of the equator, okay? Which means that most of the time, that index, so large companies in the US, are worth more on December 31 than they are on January 1, okay? But equally important to understand is that every single year, there is a red dot below the line. And what that red dot signifies is that the market doesn't just keep going up. There are always periods of time where the market does, from peak, it does slacken off some. Now, importantly, most of the time, the market, like I said, ends up with positive performance at the end of the year. So this is why time in the market is so important rather than trying to time the market. You know, we always want to buy low and sell high, but being able to figure out, to read the tea leaves and figure out when it's actually low and when it's actually high, pretty darn near impossible. And so I show this every single time I get together with clients. My clients have seen it for years and years, but I show this slide over and over again to remind them to stay grounded. And so long as the portfolio is built in the fashion that meets their time horizon, meaning when they need that money, then we're going to put our blinders on and avoid getting bothered by the noise. And we're going to stay invested and allow the long-term growth, which you can see historically has been very, very positive. So I think we're kind of rounding third base here. Okay, so it's important in times like literally today, where the market is down year to date. It's important to think about, you know, how do I get back in? When do I get back in? Or if I'm in, what is driving me to stay the course? And so it's important to understand the kind of the one thing that I can guarantee you today. And this is, again, a guarantee with an asterisk because I can't guarantee you anything, okay? But every time we've hit a market high, I can guarantee you with an asterisk that we have seen a new market high at some point thereafter. Okay, so the market basically peaked at the end of last year, and it's been a very, very rough road. The slide we're going to show you next, I believe, is through the middle of the year, where the S&P 500, again, those large 500 stocks, were down 21-ish% during that period of time, or 24% as it's shown on the bottom right-hand corner of the image on the right-hand side. So the key is, at some point, we will get back to where we were, and we will exceed that level. So what I want you to change your thinking is, think about, if I were to put $1 today into the market, or if I have $1 that's now turned into 80 cents or 85 cents, what does it take for me to get, if the market goes back to its previous level, and if it goes above that, what is the incentive for me to be invested? And so the first bar on the top left-hand side is referencing that. So again, the market by the middle of the year was down 24%. So if you had taken $1 and put it to work when the market was down 24%, when it gets back up to its original peak, you would have made 28.5%. So if that takes 1 year to do, you've made 28.5%. Way to go. Now, if it takes 2 years for that to happen, you've still generated now a total of 30%, but a 14.3% average annual return. Let's say it takes 3 years to get there. Now we're talking about 10% per year, or 33% total. Maybe it takes 4 years to get there. That's almost 8% per year. So again, it's very, very important to think about your decisions to stay, to add money, to shift your allocation in the context of, there will be a point in time where the market will rebound. I can't tell you when that's going to happen. I give you an idea of my thoughts of what will be the drivers for the market to really turn and go positive for an extended period of time, but we don't have enough time for that today. So ultimately, it's just really, really important to focus on, I may not time the bottom, but if I were to put my $1 in today, the market's down about 15%. So it has buoyed some from that low. So if you were to invest, now where the market is down 15, I wrote this down on my notes earlier, and it takes a year to get there, you're going to be at 17.6%. So if it takes 2 years, that's 8-ish% that you're going to be making. Long-term historical returns of the market, you could say, are 8 to 10%. So it is important, again, overcome your emotional hesitancy and focus on time in the market, not trying to time when the absolute best, moment is to put that capital to work. So I talked about the Fed, or I alluded to the role of the Fed in things earlier, and I don't intend to spend too much time, but I do think it's incredibly important to understand the role of the Fed and a couple of terms that, unless you've been living in a cave or under a rock, you probably have heard, but you likely had no idea what they meant. And so the first term is quantitative easing. And quantitative easing is something that the Federal Reserve started doing. They coined that term coming out of the great financial crisis. Basically, there was a liquidity problem. Companies needed businesses to stay afloat. No one wanted to lend them money. And so the government stepped up, the Federal Reserve, and they basically printed money, and they started loaning it to the government. And in some instances, loaning it to individual businesses or bailing out those businesses to keep them afloat. And lo and behold, that more or less worked. By reinfusing capital into the economy through quantitative easing, or QE, they were able to help support economic activity and keep the wheels of the economy, squarely on the track. Now, you could argue, was it the right move? Was it the wrong move? Did they do it too long? Not here to argue that at all. I just want you to know what QE is and how it compares to the environment that we're living in today, which is one where the Fed has completely changed their playbook And now they're conducting quantitative tightening. So what in the world is that? I mean, at its core, it's the opposite of the role that they were playing previously. Instead of trying to bolster economic activity, the tightening is occurring in order to shrink economic activity to curtail inflation. Okay, they're trying to keep prices moderated. In fact, the Fed has a dual mandate. It's to keep price levels stable and to support employment. And it's not something that they can pull a lever and really fix both in the same move. And so the Fed is kind of walking a tightrope, trying to both ensure that people have jobs, that employment is at an appropriate level, but also that there aren't too many dollars flowing through our economy. And those dollars are chasing too few assets, and prices are going through the roof. And so what the Fed has done is, instead of quantitative easing, where they were creating money, they were using that money to loan money to the government, to the US Treasury. They were loaning money to US corporations. And they were keeping the federal funds rate, which is just very simply, it's the rate that banks borrow from one another overnight. That's the only interest rate that the Federal Reserve can actually control. They can't control the yield on a 30-year Treasury bond or what Microsoft pays to borrow money for 10 years. They only control that one rate. But at the start of this year, that rate was 0 to 0.25%. It's always a target. And they started raising that overnight rate. And in turn, mortgages got more expensive. Credit card interest rates got more expensive. The price you pay on a car loan got more expensive. The price that Apple, Microsoft, Amazon, Ford are borrowing got more and more expensive. And as you are probably aware, when things get more expensive to borrow, it's hard to keep paying higher and higher prices for them. And so that is the role of the Fed. Again, stable employment, stable prices. And right now we actually have a pretty strong employment market, but we have, inflation that's way hotter than what the Fed is comfortable with. And that's why they've been taking the tightening steps that they have. And we're going to see actually how that's played out on the next slide here. So the Federal Reserve is not a federal entity. Let me be clear on that. The Federal Reserve is just the big organization that runs the banks in the US. It is essentially, it's a private organization, okay? But they have their finger on the pulse of the amount of money that flows through our economy, okay? And so all I want you to understand from this slide, without getting into treasuries and MBS and all of this stuff, is that the Fed's balance sheet, the money that they've lent out, has grown by leaps and bounds over the course of the last decade. It was less than $1 trillion. And it's amazing how a trillion just gets thrown around like nothing these days. But $1 trillion, 1,000 billion is a lot of money. It was less than $1 trillion back in 2003. The great financial crisis occurred, and you saw the TARP programs and all of these different facilities to provide liquidity to keep businesses operational. Well, they created money to help bolster things, and it worked for a period of time. And then COVID happens, and once again, the economy basically stopped, not because people didn't want to spend the money, they just had nowhere to spend it. In order to keep businesses afloat, yet again, the Federal Reserve stepped in and they sliced interest rates down to nothing to make borrowing very, very cheap. And they also created trillions of dollars of capital that was shoved out into the economy. And that happened right up until the beginning of this year. And this is where the Fed pivoted and they completely changed their playbook. And they said, oh gosh, inflation is way too high. The price for that gallon of milk is, they're not even selling a gallon of milk. They're selling 3/4 of a gallon of milk so they can sell it at the same price they did, 6 months ago. They're calling it shrinkflation. But ultimately, things are getting too expensive. and it's very, very inhibiting to people. You know, am I going to be able to put food on my table? Am I going to put gas in my car? Am I going to be able to pay my rent? And so the Fed is now tightening the screws, and they're looking to shrink their balance sheet. What's happening is a couple of different things. So number one, you hear about the Fed meeting and the Fed raising interest rates. Well, they're raising that federal funds rate in order to make everything else more expensive to borrow. Number two, they used to be buying bonds. They're no longer buying bonds. If supply and demand, if more people are buying something, the price of it is going to go up and the yield on those bonds are going to go down. That's how they kept mortgage rates so low. The last thing that's occurred is now when those bonds mature, they're actually just evaporating into the nothingness. The Fed is allowing those bonds to go away. They're not reinvesting the money. And that's why the forecast is for that balance sheet to shrink. And so, again, when there's a great term, it's don't fight the Fed. Okay, so there's like 3 or 4 different things to take away from this. And the Federal Reserve plays a very, very large role, both in kind of the earnings of businesses. If it costs me more to borrow, I'm going to have less profit, but also in the emotion. When we think that the Fed is going to make it harder to make money, then we're going to see asset values go down. And that's basically what we're living in today. And until there is a sign that the Fed is going to pivot, it's probably going to be more volatility ahead. So the last thing that I want to get in, because I spent a lot of time talking about stocks, is bonds. Again, bonds are your ability to lend money to the government, lend money to municipality, lend money to a specific business. The key is that, traditionally speaking, bonds are looked at as a safe haven to invest, because you are, if things go to heck with a business, you are higher in the stack, meaning like if we were talking about a buffet, you're at the buffet line in the front. And so you get fed first. And the stockholders, if there's no food left at the end of the day after the company's been liquidated, then they get nothing. They're in a higher risk position. So in many times, people will balance their portfolio using both stocks for growth and bonds for safety and income. Unfortunately, this year has been an anomaly in a sense that while the stock market was going down, unfortunately, the bond market was facing very, very significant headwinds as well. And the important element to understand is when prevailing interest rates go up, the value of an existing bond goes down. Second factor, the longer that loan is slated to be in existence, meaning a 30-year loan to the government, a 30-year treasury bond, the value of that today is impaired significantly more than if it's a very, very short term remaining on that particular loan. And you can see that the top left box shows that when this graph was printed, the 2-year treasury was down 3%, 3.05% year to date. Meaning if you owned that, the government was still paying you the income, but the value of that note had gone down. Why? Because if I have a note that pays me 4, but now rates have gone up and a new 2-year note is at 5, well, that 5 is a lot more attractive than my 4. So the value of my 4% yielding note is going to go down, meaning that someone is going to have to buy it from me at a discount to be happy to go ahead and place that trade. And it gets worse the longer you look out what's called the yield curve. And we look at the 30-year, those bonds, you've safely lost 23.5% year to date. In fact, if you look at the US aggregate bond index at this stage, it was down 10.35%. So in many instances, folks are told that they should have balance. They should have stocks and they should have bonds. But the reality is those bonds have not done what they have been prescribed year to date, but we are not investing in the rear view mirror. And I think it's very, very important to potentially look at bonds as something that do make sense to invest in if they're the right fit for you, of course. But things have shifted And it may make sense to add some of those back to your portfolio now. So I think it's been probably drinking out of a fire hose going through and listening to me. So I will pause there.
All right, we do have a couple questions before we end today, and then we'll let our attendees go on with their day. So you talked a little bit about how the stock market is often driven by emotion in addition to the the valuation of the particular security. Can you talk about how emotion should play in your own personal investing?
It should play no role in your own personal investing outside of, I like to tell people, especially if you're going to do it alone, invest in things that you know. The biggest two questions that you should always ask when it comes to investing, frankly, in anything in life, is why and how. Okay. I hear radio commercials all the time about these incredible real estate investments that pay a safe 18% secured internal rate of return. And what you need, because that can be, hey, that sounds great if it's real, but you need to ask yourself, why in this environment today how in this environment today can they invest in something and generate a safe, secure 18% return? And so the reason why I use that example is because the initial emotional response is that sounds great. I want some of that. But we need to push emotion down and use our critical thinking to ask those questions. Is how are they actually going to generate those returns? Is it realistic? And if it's not, you promptly disregard that from your memory bank, or if it's something you got in the mail or in your email, you hit delete or you throw it in the trash. So focus on keeping your emotion controlled. And really, it goes back to portfolio construction. You need to have your playbook that is customized for you. And frankly, husbands and wives and spouses, and they don't always see the world through the same lens when it comes to risk. So you need to have your playbook customized for you so that in good times and in bad times, you stay in the center of things.
All right, and then one more question here. Can you talk a little bit about alternative investments? So we talked a lot about the stock market, and I know that maybe, and this is maybe a teaser for the other webinar we're doing. Can you talk about other options for investing that aren't in the stock market?
Yeah, without getting into too much detail about alternatives, the biggest thing to understand about them is you are, in most instances, introducing some element of illiquidity to your portfolio. If something can't be bought today and sold tomorrow, it's going to tend to be valued more in line with what it is. Real estate doesn't necessarily care about a tweet or fill in the blank, news coming out. Are the tenants paying? Is the occupancy still there? Are you able to pay your mortgage? All of those things are at the root of the business, and therefore the driver for performance, both good and bad, are driven so much less by emotion and much more by the actual profitability of the business. So when you add alternatives to your portfolio, you're lowering what's called correlation. Because if you have your traditional bucket over here and everything is kind of moving either good or bad in the same direction, by adding alternatives in, you're going to have a piece that's marching typically to its own drummer and can generate returns that are not going to be moving in lockstep with the other pieces of your portfolio. Ultimately, that's how we lower the risk that you're taking, but it's in exchange for potentially taking on the risk that if I need the money tomorrow, I cannot sell this thing, or if I can, I might have to sell it at a discount. So you must weigh those two factors when deciding whether alternatives are appropriate for you.
All right, well, that's about all the time we have today. I want to thank Kelly for being here and for presenting I think, a very informative webinar for us today. And I want to thank the organizations that have worked with us to bring you this webinar. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Every one of our advisor partners has agreed to offer an initial consultation to anyone we introduce them to for free. And our matching service is also free. So all you have to do to find an advisor is go to advicechaser.com and click on the link to find an advisor. Well, once again, from all of us here at Advice Chaser, thank you so much for coming, and we hope to see you at another webinar soon. Goodbye, everyone. Thanks a lot.